Hey, what's going on, guys? So it's Henry back with the video, and today I want to talk about hedging your portfolio, how I'm hedging my portfolio, all of my holdings. I'm going to go through each of my positions, why I'm holding it, and I quickly want to discuss ARK Innovation ETF as well, how Cathie Wood is doing, how my portfolio is doing in regards to Cathie Wood. So welcome, you are in store for a really good video. I'm going to show you exactly how I'm investing, and you can get a lot of ideas for yourself during this bear market and during these volatile times in the market with really high inflation and really high interest rates. So you're in store for a really good one. Just make sure that you smash that like button for me, as it is really appreciated, helps out the YouTube algorithm. And in the description, there's a link for OptionsFi as well as my Discord. So over the past 3 months, ARK Invest ETF, the ARK flagship fund, is down 27.49%. I used to own a lot of similar stocks and I'm down 11%. So I'm not completely immune to the market. I have some losses as well. Everyone has some losses. I mean, billionaires, Warren Buffett, everyone. I want to make it clear that I'm not immune to the market. So I'm down 11%, but I hold so many similar stocks to ARK Innovation Fund, which is down 27%. So I consider this a really, really big beat. In fact, I'm down less than half of what Cathie is down on the past 3 months. And I've been able to do this by hedging my portfolio significantly, getting out of certain positions. And anyways, let's just go through my positions and I'll show you why I'm doing certain things. So position number 1 that I have right now is Adobe. And that's because I showed my Discord members that basically Adobe has a very high price to sales ratio. In fact, the price to sales ratio on Adobe is very similar to Tesla. But the issue is that Adobe isn't really growing as fast as Tesla. It is a really good software. It's involved in the creator economy. In fact, I pay for Adobe software myself, but I think it's a little bit overvalued. So what I'm doing is a call credit spread. I have a video on call credit spreads in the description, but this is a call credit spread basically where I'm selling one call option, okay? The 450 that I'm selling is essentially me saying, hey, I don't think this stock is gonna go above 450. And this option actually expires this Friday. I'm up 31% on it, $195. Not bad for a really small position. This is a small account play because the difference here is 450 to 460. That's $1,000. It's $10, but each option is 100 shares, so that's $1,000, right? And I've collected, let's see how much I've collected. I'm gonna click into this position. So on $1,000, I collected $125, and really this is about $125 on about $875 worth of collateral. That's because I did risk $1,000, but I'm collecting $125, so I'm really risking $875, not $1,000, since I did collect $125. So the actual return is about $1 for every $8, which is about a 12% return, Super happy with that. So as the market falls, this small position could make me 12%, and it's already up 31%, about $200. So really good position to have. I still think selling call credit spreads on Adobe makes sense. I still think this is an overvalued stock, and I'm not bearish on Adobe. I just think it's overvalued. I think it's a great company long term, but I don't want to be in at these prices. And as you saw today, I did the same thing with Tesla. I actually had to exit Tesla. I made a whole different video on that this morning. So when I scroll down, you'll see that I no longer have Tesla in this portfolio, but I'll get into that in just a second. The next thing that I'm doing is I'm selling put options on Facebook. You can see the Facebook chart right here. I'm using Yahoo Finance, really simple, really easy. The RSI is 49, so it's right in the middle of not being overbought or oversold neither. It's in the middle of the Bollinger Band here. It's right in the center. And if I make a moving average, if I go to indicators and I go to moving average and I do 50 days is fine. You know, I usually use 60 or 30, doesn't really matter. 30 to 60 days is completely fine. So if I save this, the moving average is 204. So I think Facebook is heading back to about $200 per share. So for me, selling a $180 put option is a no-brainer because the bottom of the Bollinger Band is actually 183. So for me, $180 put option makes complete sense. I'm up 65% on this position. And every single Monday, I open up a new Facebook put option in the Discord because it's pretty much easy money. I've been doing this for probably like 5, 6, 7 weeks now. Really easy money. Even in the bear market, I don't think Facebook's gonna go down to $180 per share. So this is a very easy position for me that I've been making consistent money on. Now, I actually opened up Palantir yesterday and I wanted to open it up a little bit sooner. I've been making videos on Palantir again. I've become very bullish on Palantir. So I decided to sell the 8.5 put option. My goal here is that even if Palantir goes down to 8.5, I'm gonna run the wheel strategy. If you wanna watch a video on the wheel strategy, it's also gonna be in the description. The wheel is essentially selling put options to get in. And then as soon as I get in using put options, I now have 100 shares. So what I'm gonna end up doing is now I'm gonna sell some call options to collect some more premium. So that's the position that I'm running on Palantir. Again, a lot of these stocks are pretty much Cathie Wood stocks. I mean, she has a lot of these tech plays and I'm a tech investor, so I'm mainly in tech. Now, the next thing I do have is SPY. I've been selling put options on SPY. Looks like I'm down just a little bit, but again, I'm not super concerned as long as SPY doesn't go below 408. But even if it does, I'm gonna run the same strategy as I am on Palantir, which is the wheel strategy. I love running the wheel strategy. It's one of my very favorite strategies, and I do not mind getting put stocks because I usually like those stocks, right? So for Facebook, I would like it. Palantir, I would like it. SPY is a no-brainer, right? That's S&P 500. So I wouldn't mind getting put at 408, and I would just end up selling put options. Now, I do want to show you that I do have shares of SPY. The only two shares that I have in this portfolio is SPY and Apple. So very, very safe. And that's because I don't want to be in full cash, but I also don't want to be in too much risky stocks at the moment due to higher inflation, due to interest rates likely to increase a lot. So I want to make sure that I am very protected, and typically technology stocks do not do so well in higher interest rate environments. And that's because investors are buying tech stocks because of their future cash flow, but interest rates that are higher are going to affect your future cash flow. I mean, if it's a 10% interest rate, right? You don't really want to have cash in the future. You want cash today. You do not want to wait because interest rates are so high. So those tech stocks get beaten down. They get their valuations cut, sometimes in half. And that's why I want to be careful on not being invested in overvalued or just expensive technology stocks. That's actually why historically I've sold call credit spreads on Nvidia. Let's look through my stock list right now. So Nvidia was one I was selling call credit spreads on. I was selling call credit spreads on Net, on Snow, on Baba a little bit when it was a lot higher. Now Baba's at $100, which is pretty fair to me. I wanted to sell put options on Baba at around $90, maybe $91, but it shot up a lot. So I'm just going to be patient. I'm going to wait for it to potentially come back down. But I've sold a lot of call credit spreads on a lot of those expensive high growth names that Cathie Wood had. And I think that's what really helped me outperform Cathie Wood, is that although I do hold a lot of tech stocks, I had a lot of Tesla. I had 620 shares of Tesla, as you saw in today's morning video. Although I had a lot of shares of Tesla, I ended up actually selling a lot of call credit spreads on Tesla, covered calls on Tesla. So on its way down, I was still making maybe 1.5%, 2% a week by selling covered calls. And those covered calls really helped me out. Now, speaking of Tesla, XLY, the reason I have this in my portfolio, this is going to be really interesting. I'm going to get out of ARK Innovation. I'm going to type in XLY here to show you why. But anyways, I just wanted to show you a comparison of Cathie Wood and my performance. So XLY is an ETF. It's the Consumer Discretionary Select Sector Spider Fund. Okay, the reason why I really love this right now, XLY is amazing for a couple of reasons. First of all, it has 61 holdings, right? This is an ETF. It's focused on the consumer sector. But if I scroll down here, you're going to see something really interesting about the top 10 holdings that it has within its fund. Okay, so the number one is Amazon at 20%, and number two is Tesla at 17%. So basically, both of these guys account for around 40%. So 20 and 20%, right? Amazon and Tesla. Now, I just said in my main portfolio that I sold out of Tesla, and some of the shares that I sold out were for a little bit of a loss. So I had a little bit of a loss there because I did end up buying Tesla for around $800. Some of the shares that I bought there, I think it was 50 or 100, were around for $810 or $820. So what I wanted to do, because I saw Tesla rebounding a lot, and I did have a little bit of FOMO, and I'm like, oh, did I make the right decision here? As you saw in today's morning video, I was kind of scratching my head. You know, I really don't know what's going to happen with Tesla. I don't want to be so invested in Tesla that it's very volatile for my portfolio during these harder times, the bear market, interest rates, inflation. And also I want to make sure I don't lose a lot of money in the stock market as inflation goes higher in the US, because if I want to purchase a house, then basically I'm going to be losing money in the market, and I'm also going to have less purchasing power for real estate. So I wanted to exit Tesla and not have such a big volatile position. However, I had some FOMO, and I'm like, how do I have some Tesla exposure without buying the stock back? And that's where I got the idea of XLY. I decided that selling a put option and actually put credit spreads, as you'll see in a moment, on XLY gives me exposure to Tesla. Of course, not 100% Tesla, but about 20% of Tesla and 20% of Amazon, which I also love. I was selling put options on Amazon, which is a really expensive position. It's like $250,000, right? Or now Amazon split, and I was telling everyone on Discord to buy it because it would go up after the split. And yesterday we had a 4.8 or 5% pop higher. So that was easy money. That was like the easiest money play that I have made in a really long time. And I've been telling investors that's going to happen for sure, because it basically happened to Apple, happened to Tesla. After they split the next day is super hot because so many new investors are excited about it. So that one day swing trade is really easy money. But anyways, I ended up selling XLY put options because I want Amazon, Tesla, and I'm also not against McDonald's, Home Depot, Nike, Lowe's, Booking, Starbucks, Target, and TJX, right? So I wasn't really against that. So I ended up selling a couple put options on XLY last week, and I ended up making about $520. Now I'm down $350, but I'm not concerned. Again, I'm really bullish on a lot of these stocks. Tesla, I'm also bullish on, just I am a bit afraid of holding too many shares and not being diversified enough. That's why I ended up selling Tesla. but XLY is basically like a Tesla replacement. I'm also running covered calls on Apple. I'm up $20. That's not much, but hey, it's something, and I'm running covered calls on Apple to basically hedge my portfolio further. If Apple is down, this hedge will help me out by maybe 1 or 2%, and Apple's not going to fall down by like 30%. Maybe it'll fall down by 10%. So I'm going to cushion myself by 2% on a weekly basis. So basically in 10 weeks, I can give myself like a 5 or 10% cushion. It's amazing. Next stock that I have is Lululemon. I sold put credit spreads. This was an earnings play. I had a Lulu video where I bought call options. I really wanted to buy call options again, but I didn't. I sold put credit spreads. Let's actually take a look at Lulu, what happened there after earnings. I really wanted to buy a call option at about a 295 strike, and it did go up to $301, but still the premium on that call option was huge. So I'm really happy I did not do that. I was going to do that, and I'm happy I didn't, because I would have probably broken even on that call option. But instead, I made money because I sold a put credit spread on Lululemon. And I think it's still a pretty good put credit spread as long as you go for like a 260, 250 put credit spread, or maybe even a 270, 260, because the 250, 240 is way out of the money, so it's not going to have that much premium. Next, I am selling covered calls on SPY. The same reason I'm selling covered calls on Apple. If it goes down, then I get a cushion, and if it goes up, that's fine as well. I'm kind of happy to sell at 424 in the short term. I think we are in somewhat of a bear market. I was reading a lot of Michael Burry's Twitter tweets, and he was right about 2000, the dot-com bubble. He was also right about 2008, and he may be early, he may be late, I don't know, but right now it does certainly seem to me that the market has a lot of risk here, and there's certainly reward, but I want to be as hedged as possible, so I do not mind selling covered calls. Now, the last two positions, like I said, XLY, I sold put credit spreads, and Netflix, I did call credit spreads, just because I don't think the stock is going to go up to $250 in the short term. So to recap, I'm selling call credit spreads, covered calls, selling put options out of the money. I don't have a whole lot of risky stocks, and I have Apple and SPY as stocks that I hold. No longer have a huge Tesla position in this portfolio, so being very, very careful, and that is helping me outperform Cathie Wood. It's actually helping me outperform a lot of different investors who lost pretty much like 50% of their money because they kept holding tech stocks. I decided to jump ship. I did lose some money, not immune to the market, but hey, I think my performance is pretty good. Been able to protect the portfolio a lot during these volatile times, and I'm excited for what's to come next, whether it's going to be more volatility or an up market. Either way, my portfolio is positioned to see some gains. So if you want to follow along with all my trades as the market changes, then feel free to check out the description for the Option Academy, which is the Discord where I do coaching on Monday and Wednesday. There's 3 other coaches as well as a full course. There's master videos. There's Uncle Insights where I give you an insight into the market on a frequent basis. There's also Henry Trades where you get to follow along with all my trades, with my spreadsheet, with all my positions. Basically, there's a whole academy there to teach you how to trade options professionally, and I'd love to work with you and coach you. Either way, thanks for watching. Leave a like on the video, and I'll see you in the next one.